All right, good afternoon, everyone. Thank you for taking the time and tuning in today. I'm Ryan Bouchey. I'll be joined today by Marty Shields and David Rath, and we want to go through, what we're looking into, what we're researching, and our approach right now, and the firm's approach to what's been happening with this coronavirus. So, this presentation is going to focus mainly on the economy and the stock market, how it affects the portfolios. But throughout all this, everyone here certainly hopes that everyone's staying safe, doing what's necessary for any sort of precautions, and do not want to make light of that situation. But as we said, this presentation is really going to be focused on what's happening with the markets and what's going on in the economy. So why don't we kick it off? So this week we had an emergency Fed intervention. They jumped in, cut interest rates by 50 basis points, a half a percentage point. And, in terms of how the markets reacted, we saw some very, very brief positive reaction. And for the most part, to kind of end this week so far, we'll see what happens over these next few hours. But most of the market reaction has been pretty negative. I think, as investors sort of have digested the news, two things come to light. One, a drop in interest rates will not stop if this pandemic or this virus becomes worse than what we're seeing right now. Interest rates aren't going to protect or prevent that spread. Two, and I think this is a even bigger issue as time goes on, is that the lower interest rates go right now, the more vulnerable we'll be if the economy were to turn and do worse. And so, looking back over the last 20 years, we've seen a history of Fed intervention. And, we saw it in 2001 when the tech bubble came crashing down, and we saw three rate cuts during that point. We saw it again in 2007 into 2008 with the financial crisis. We had three different elements of emergency Fed rate cuts. And then again this week, we saw it for the first time with regard to the coronavirus. And, with all of these situations, most of them were, really centered around economic issues. And so far right now, the coronavirus, where it can infiltrate our economy, it's more of a health issue. And so it is definitely different. And even when you look at right now with the markets pricing in for another Fed rate cut, there is I saw yesterday, 83% chance that in the next coming weeks, we'll see another cut. And, whether or not that happens, it's yet to be seen. But, right now we're at 1%. If the Fed continues to cut rates, if the economy does turn south, we're left with less and less options to try to stem that slowing economy. So let's kind of break this into a few different segments. I'm going to start talking about why, this outbreak has been different thus far. And just on a very, comparing it to SARS. I think SARS was the first virus that we started comparing this to when it first became news about a month or so ago. And when you start looking at it, early on, it sort of fit that pattern. Very similar in terms of the effects and where it originated from. But as you can see, so far, the coronavirus has been much more impactful in the growth and the spread. Today, we're at over 100,000 cases worldwide. And so we're seeing a huge, huge difference in terms of how this is growing and how it's spreading. Looking at infection and fatality rates, this is kind of a fluid situation. We're seeing this change on almost a day-to-day basis, right? But so far it looks like it spreads easier and faster than the common flu, sort of right in line with what SARS was almost 20 years ago. In terms of fatality rate and how dangerous this is, we're seeing a real divergence in terms of younger versus older, or healthy versus maybe having a pre-existing condition. And so as time goes on, I think we'll get a better handle of this. Hopefully we find out that maybe there are, two ways to look at it. Good, positive that, maybe more folks have had it and it's been less severe. But at the same time, that may mean that this thing could spread even more than what we're predicting. So many unknowns with this. And I think that's the biggest takeaway so far, is that there's just so many things that we don't know about it thus far. But as every day goes on, we find out more and more. In terms of what's different from an economic standpoint from SARS or even 20 years ago, and we use these slides from the state of the economy, so I won't spend too much time on it. But in year 2000, you look at this is the comparison of U.S. and China, U.S. in blue, China in red, and this is us as a global supplier of goods to the rest of the world. Going back then, the U.S. had a stronghold on the rest of the economy in terms of what we supplied for goods. And you look at today, you see how much of a bigger player China is in our world economy. And outside of North America, really China leads the way as the dominant exporter. So, as China goes, in some cases, so does the rest of the world in terms of supply chain. What did that growth look like over the last 20 years? Well, you look back, in blue is 2002 and orange is 2019 for China. You see the growth as a global industry. You see growth from a global GDP perspective, from a global trade, tourists. I mean, all these factors. China has such a huge impact on the rest of the world, being the second biggest economy now, that when we see instances of a slowdown there and what they've been going through with regard to their lockdown, there's certainly some real concern and a much bigger economic concern than we've ever seen before with a condition like we're seeing right now in China. Lastly, from what's changed and what's different from 16, 17 years ago is the rate of growth in international travel. And this is a big factor, and we're seeing this come to light already. And over the last 20 years or so, international travel has doubled. And so this makes up a big element of everyone's economy, and some countries are more prone to any sort of disruption here. But from a global scale, we've seen international travel pick up dramatically over the last 20 or so years. And so that has a big impact on how this could affect world economic figures. Let's take a few minutes to kind of look at what our biggest concerns are right now, and what we're looking at from a worst case scenario standpoint. When you look at global growth, and we talked about this a little bit during the State of the Economy, outside of the one lone bright spot, which is the U.S., global growth and global GDP growth has been declining over the last couple of years, and we're seeing some real slowdowns throughout the rest of the world. China had been slowing down. Areas of the Eurozone were slowing down. Germany, Japan were all slowing down. And so, we had some good news at the beginning of the year with some of the trade resolution with China. But, as this coronavirus has come to light, that's put a halt on a lot of that trade negotiations and the trade what they had worked out. And so, the fact that we were already sort of declining from a global standpoint, and then having this other factor, this could really spiral into something more major from a global growth perspective. We look at how big of an impact China has on global share of manufacturing, and this goes back to 2018. But China, from a manufacturing standpoint, made up almost a third of global manufacturing, and that is a huge number. And when you see a country like that get shut down, whether cities or the entire country in certain aspects in terms of what they're able to manufacture, that could have a ripple effect throughout the rest of the world. This was a survey taken a few weeks, about a week and a half, 2 weeks ago, out of China, some of the decisions they're making. And you take a look at this. This is actually really, really scary when you look at their impact and what they're doing. Reduction in salaries, more than 40% said that would be impact from this. Layoffs, almost 30%. Headcount reduction. Some companies are going to have to file for bankruptcy. There's just a lot of uncertainties happening in China right now. And, depending on how this thing spreads and how it can be contained, this is something we really need to watch for. Why is, this idea of global supply chain? So we've talked a lot about this. This has been one of probably the biggest risks to not only China's economy, but also the rest of the world, specifically, even US, some of our largest US companies. So you take, for example, Apple, and I pulled this right from Apple's website. Apple has over 200 suppliers. If you go through that list, they didn't break it down by country, but if you just start looking at it, I would say 80 to 90% of those suppliers are made up of Chinese or Taiwan or Hong Kong type based companies. Very few are based in the US. You think about the iPhone, for example. iPhone is made up of over 1,000 different components. You look on the right hand side of this chart, about 75% of global smartphone manufacturing is happening in China. And this is just one element of, one area, one subsector of technology companies. But, Apple's our largest company in the US. And when you look at, their biggest product being the iPhone, how closely it correlates with what's going on in China and how much we rely on China, this uncertainty could certainly, trickle down to our US companies. What could the macroeconomic impact be? Hopefully, in best case scenario, this virus gets solved and eradicated, and much like the seasonal flu does. But from a macro standpoint, this was something that was happening last year already with regard to the China trade negotiations. U.S. companies were having to find different ways and maybe other avenues than to rely so much on China. And this is an example of just Apple. And when they sell an iPhone, how much of the sales price, stays with, Apple, the company, versus where the costs are. And the great thing about Apple and why it's such a valuable company is that their profit margins are so high. So for a sale of an iPhone, over 40% of that sale price goes back to Apple. That's a huge, huge profit margin. You go through, cost of materials, distribution, IP licenses, unidentified labor. Then you look at China and the labor costs there, and this is why China has been such a huge, huge player in this global supply chain, is that labor is so cheap. Well, if we have to, change the way these big U.S. companies are doing business, if we have to bring some of that back to the U.S., and probably from a grand scheme of things and in a big picture approach, probably a good thing. But from a stock market and stock price approach, that could really start impacting their bottom line and start creeping into their margins. That may not be good for stocks. And when you look at some of these big global companies that have a huge, huge supply chain reliance on China, this could have long, long-lasting impacts further, much further than if this coronavirus gets solved in the coming months. You're just looking at the growth rate of the virus. So this is how in the black bar, that's the growth of what we experienced in China. And we're looking at now, South Korea, Iran, Italy. And the point of this chart is really just showing that in these outbreaks in other countries, they've all followed a similar path. And so, again, we'll continue to see how this grows, if it starts to taper off. But we're seeing, the effects outside of China have been very similar to the effects in terms of the spread of the disease that we did see in China over the last couple of weeks. So just to recap some of our biggest concerns: global trade and the economy slowing down prior to the outbreak. We were already experiencing some headwinds. Pull this into the mix and factor this in. This could have serious downside consequences. Most global companies aren't even aware of some of the risk exposure. They have so many suppliers in China, and so many different suppliers are relying on other suppliers, and that having a real firm grasp on how large this impact could be is really hard to put a number on right now. Obviously, if this virus turns out to be worse than expected, either from a spread rate or how serious it is or how bad it can be, that's obviously a huge concern. And quite frankly, we really don't know what the effects are going to be just quite yet. And lastly, having this be a potential catalyst to drive us into a recession. And at this point, as we spoke about earlier, the Federal Reserve is really lacking any sort of ammo to try to slow down a recession from an interest rate perspective, if that's a path that we fall into. So, there's a lot of concerns out there, a lot of things we're watching. Doesn't mean these things will happen, but we certainly have to take into account from a risk perspective. And so with that, I'm going to turn it over to Marty Shields, and he's going to talk a little bit about some of the things we're looking at from an optimistic standpoint.
Good afternoon, everyone. So I want to go through and highlight some reasons for optimism. I always say if you're going to be an equity investor, you have to be optimistic about the future and the U.S. economy. And, it's important to remember that, during this times, it's easy to get concerned or have some anxiety. But, this will be short term. We'll get through this. And on the backside, the stock market is resilient. And we'll make sure we, have your portfolio positioned properly, but this is not something that will derail the stock market from moving forward long term. So Ryan talked about some of the concerns from an international economic perspective, but let's talk about some of the things we're seeing domestically. And I think it's important to know that as we go into some of this uncertainty, that the economy for January and February in the U.S. has been very strong. So the labor numbers came out for this quarter, for February, and 273,000 jobs were created in February. The numbers for December and January were moved up for new jobs, and the unemployment rate is at 3.5%. This slide shows basically strength in the housing market. So the dark blue line is 2020, and the other lines of the past 10 years for the MBA Purchase Index, which is really representative of the housing market. And you can see that the way this January is February and starting off is stronger than the last 10 years. And we've talked about the importance of the housing market as far as the overall economy. And we're seeing strength in a lot of other areas. But again, that was January and February. But the importance of this is going into this area of uncertainty, at least the economy is strong versus declining domestically. As far as another reason for optimism is the slowing of new cases in China. So you can see from this chart that we're basically looking at cases increasing for approximately about a month and a half in China. But then because of the efforts that they're making over there, you're actually seeing fewer cases, which from our perspective is very important. Again, if we do have a rise in cases here, if we can take some approaches to limit some of those cases, hopefully we're talking about a 2-month period of time where that can be stemmed if it's similar to China. Another real positive is, relatively speaking, from a U.S. perspective, you can see from this chart, our economy is not as dependent on tourism as other countries. So you can see we're more on the right-hand side of this as far as percentage of GDP. Under 4% is what tourism makes up for our GDP. So, it could definitely impact our economy as far as fewest tourists coming over here. But versus some other countries, it won't be as dramatic. And then what we're always looking at is different scenarios and trying to understand, how is this going to impact the economy? So we look at it 3 different ways, right? One is a V scenario where you get a sharp downturn for a quarter and then a strong bounce back. And that the left-hand side scenario, you can see that bounce back is pent-up demand, right? So you get to demand that declines in one quarter, but then the next quarter or two, it really shoots back up. That's probably the more likely scenario. But there are 2 others, one where it does come back up, but in a slower fashion, so not as dramatic. And then a third where it's the less likely, but that you can see that GDP growth is going to decline because of the nature of the pullback. That would be, again, the more unlikely one, but that would probably be the one if there was a recession that came from this virus in the economic pullback. But again, I really want to stress that is the less likely scenario of the 3. And then, we talk about this all the time when we have a webinar or in our State of the Economy presentations, but from a long-term perspective, how resilient the stock market is. And, if you're an investor in the market, you're a long-term investor. And, we've had many cases over the last 60 to 70 years of a global pandemic situation. And, the market will pull back short term, but long term, it will continue moving forward. So again, just having that mindset of being a long-term investor and not getting caught up in the headlines and constantly watching the news and having a negative impact on your outlook. So from our perspective, what would change our outlook as far as how we position the portfolios and make us more optimistic is if we see the number of active cases in the US beginning to slow, if the virus is less severe than what some of the forecasts are right now, we're going to see high volatility as long as there's as much uncertainty as there is. So again, if two of those first two start to actually become a little bit more limited, the volatility will damper down, and that would make us more optimistic. We think that right now there's certainly a good bit of negativity built into the stock market, and when you look at stocks now, they're certainly more fairly valued. But really, what we're looking to see is how quickly do people go back to the normal routine. It is a possibility that this becomes more just like the normal flu season. That's you hear from some medical experts. So again, we're going to kind of keep watching things to see how this plays out. And as we look at this data, it's going to determine our outlook with the portfolios. So let me just wrap up with some conclusion and outlook. First, what we do know, right? So Ryan talked about how this is impact the global supply chain. It's definitely going to impact profitability for corporations for the next couple quarters, and ability of companies to be able to supply goods and services. It's definitely going to reduce the overall GDP for the next quarter or two. You're really seeing governments, companies, markets, and consumers really try to figure this out. And I think that's, from our perspective, why we made adjustments to the portfolios. It's just the level of uncertainty that exists right now is pretty high. So we'd rather be a little more conservative. But until we see some more direction in how this is going to be handled, we'd rather be more conservative than not. And then again, the Federal Reserve reducing rates, is it really a positive thing? I think it helps from a psychological perspective, but at the end of the day, that's not going to prevent the pandemic from spreading. That's an important thing. So what we don't know, again, is where we stand with this virus and what's the direction, how long it lasts, and how many people will be infected. We don't know how dramatically the supply chain has been impacted and how long that's going to exist. And then, again, the overall impact to both profitability for corporations and the U.S. and global economy. It's too difficult to determine that right now. So what do you do in this circumstance? First of all, as we've communicated to you, and Steve sent out an email earlier today, we are currently, our target for equities is below what our target weight is usually. So we're overweight in fixed income, and we feel very comfortable with that given the level of uncertainty. We will make decisions to when to get back in the market, and either it's going to be a situation where the market's declined dramatically and we want to buy in a lower price, or as I mentioned, the level of uncertainty has been removed. Then again, it's important that all individuals not overreact to what's going on. So for individuals that are taking distributions, we have 2 years of cash set aside in a more conservative allocation so that we can sustain through any downturn for 2 years or longer by providing those distributions. If you're in a situation where you have cash and you've been looking to put it into the market, this is starting to be a good time to do that. So I would really encourage you to reach out to us about getting that cash to work and putting in a plan to get you invested. If you're an individual that is looking to become more aggressive, changing your risk tolerance, again, this is the time, or if the market continues to decline, to take a larger allocation to equities and be more aggressive in your portfolio. And if you're contributing to your 401k plan, this is also a good time for future contributions, change it to a higher percentage of equities that you're contributing to in your 401k plan. The importance of a financial plan cannot be understated, especially when we go through times of volatility. So if you don't have a financial plan in place, please reach out to us so that we can get one in place for you so you understand what this short-term volatility means to your long-term plan. And then finally, with interest rates as low as they are and they continue to go lower, I would really encourage anyone that has a mortgage out there to look at what the rates are now, and if it's worthwhile to refinance, it may be a good option. And then again, just always thinking about what it means to be a good long-term investor, right? So trying to time the market in a dramatic fashion is not going to work. It's more likely a good recipe to do the wrong thing. And being a long-term investor, just keep reminding yourself of that means doing the right things when things are good, but also when things are not good, thinking more long-term and not short-term in nature. And then finally, just trying to keep things in perspective. So this chart looks at what happened during the Great Recession. So the green line is an all equity portfolio. The light blue line is a 60-40 portfolio, 60% equities. And the darker blue line is a portfolio with 40% equity, 60% bonds. And what you can see is if you were in a portfolio with 40% equity within 2 years, so hitting the market peak in October 07, having the equity markets go down 50%, and then within 2 years, by November 2009, with a 40-60 portfolio, you were back to even. If you were in a 60-40 portfolio, which is our growth allocation, within 3 years, you were back to even. And again, this is through one of the worst downturns from a generational perspective. And then in an all equity portfolio, it took you 5 years to get back. But the importance on this is, if you're getting close to retirement and you're in a growth and income allocation, definitely reach out to us as far as making sure you have a plan in place and a plan for providing cash distributions. But if you're in a growth and income portfolio, again, through the worst downturn in a generation, within 3 years, you're back to even. So again, I think it's important to remember this is short-term in nature, and we will get back to the bull market kind of getting back in place. So we're just going to go through a few questions that we have. So David Rath is going to be joining you to provide answers to some questions that we received. Thank you.
Hello, everybody. Thanks for joining us. So we did have some clients write in with some questions, and I'd like to just go through them right now. So I'll read them out and then give my thoughts on each of them. The first one is, wouldn't it be wise to buy the companies which are making the masks, kits, and germ-killing wipes? This is a great question, and the thought process is one that is fairly common because, of course, there is going to be an uptick in demand for that kind of thing. The only issue is that markets are incredibly efficient, and usually by the time something like this is already out in the news, there's been a lot of people who have kind of gotten in early to that party. So one thing, when you are investing, you never want to be late to the party, right? You never want to pay a premium for something or an investment idea that's already out there. So while it may make money in the short term, there's also a chance that it might not. And I think any deviation from what your standard plan would be is something that we wouldn't necessarily recommend. So while it is a good thought process to have, there's a lot of other investors and investment firms out there who have had that same thought, and usually that investment idea is already priced into the market. The next question is, with the 10-year bond at all-time lows in yield, what's the strategy for bond fund holdings, seeing that even a return to recent levels will produce losses? At this point, isn't cash a better option? This is a great question. And there's two elements to the return on, well, also stocks, but especially fixed income. One is going to be the yield that is offered. So with the drop in yields, we are seeing less of a potential for any sort of yield generated by these instruments. The other aspect is going to be the capital gains that are generated as more people buy bonds, and you're seeing that in the U.S. aggregate bond index is up almost 5% for the year. It's up over 10% over the last year, as investors are piling into those bonds to generate some safety. So the strategy, and it's one that we're actively discussing, is to be vigilant and see where those interest rates, are residing at the moment, where there might be some more risks, where there might be some more risks in the portfolio, and of course adjusting along the way as we see fit. However, I do want to point out that not all of our bond holdings are going to be exposed to interest rate moves on both the plus and the minus side. We have some incredibly short-term funds that aren't as exposed. They're more there as a stabilizer within the fixed income. So we do have a diversified approach within fixed income that will isolate or at least mitigate some of the risks of a rising interest rate environment. Finally, what specifically is the plan to increase or decrease equity risk relative to the status of the virus? What are the triggers or metrics that will determine action? On honestly, when it comes to making a decision about, are we pulling back from a defensive posture, or are we looking to add to the equities in the portfolio and get back to target, there's a variety of different metrics that we look at, and we're always looking to the market for clues. So we're looking at different levels in the market, seeing where there might be some either support or resistance built into the prices. Things like the volatility index are a good clue. Right now, the volatility index is at one of the higher points that we've seen in the last 10 to 12 years. And it's something that is baked into our, it's known as a weight of the evidence approach, where we're taking little bits of information and different clues from parts of the market that will help us guide us in the direction that we're going. So while we can't point to any one specific thing, we look at a lot of different things that will eventually guide our decision. And Ryan is going to jump on for one more question and close it out with that.
Thanks, David. And just to piggyback on that a little bit, we did make some trades last week, and I know my father had sent an email earlier today discussing a little bit about what brought us to that point. This idea that it's a little bit of an insurance policy with so many unknowns right now. But from a big picture standpoint, and one of the important things to remember is that these changes and becoming a little bit more defensive has actually been going on for quite some time. You go back to the beginning of 2019, bringing the portfolios from overweight equities down closer to target allocation to the target based on your risk tolerance. Towards the end of 2019, going into a little bit more defensive equities. Some of the low volatility, some of the equal weighting exposure that we had in equities, that was a defensive move. And then as we got into last week, again, with so many uncertainties, making some trades to be a little bit more overweight fixed income. But it's always a long-term process here. And we've been making some of those changes over the course of 12 to 15 months. So just important to keep that in mind. And the last question that we did have was, I'm 63, my husband's 67. Our intent was start drawing soon from their portfolio. Ensure if we have 10 years to recoup any losses caused by this event. Should we consider moving investments to more secure investments in the short term? What would the advice be? And I think, going back to that slide that Marty showed, it's so important to remember, the Great Recession we saw in 07 and 08 was the worst economic and market drop that we've seen since the Great Depression. And you look when just having a growth and income portfolio, being able to recoup those losses within 2 to 3 years, having that long-term approach, 63, 67, we're still planning for 25, 30 plus years of having your money work for you. And there is the risk of becoming too defensive or too conservative and missing on any upside. So I think having a plan, being disciplined with your approach, and more importantly, making sure you're reaching out to us and working with us to go through your financial plan, just to give you a little bit more peace of mind, but really being able to plan for all of these events. So with that does conclude today's webinar. We appreciate everyone joining us. Try not to watch too much of the news throughout the weekend. But if you do have any questions, you can always give us a call, email us. We're here, and we're happy to discuss any questions or thoughts that you may have. Again, we appreciate it and have a great weekend.